Hello, welcome to Todd Miller TV, joined here today with Oana. We're going to talk about investing in real estate in Las Vegas. Okay, so I get a lot of calls from people who say, I've got 30 grand cash, I want to buy a house. Is an investment property. And I say, if you would, I think to myself, if you'd only called like 3 years ago, we could have done that. Maybe even 2 years ago. So what's the floor? What's the bottom you can get into the market here, cash?
Probably about $110,000.
Okay, 110. What happened to the $30,000, $40,000 houses?
They were purchased and they're now worth a lot more.
Okay. All right. Probably a lot of them double the bottom end.
Oh yeah, definitely. I mean, look, if you bought a house for $25,000, 3 years ago, yeah, it's worth $50,000 now.
Okay.
And those people are not selling them; they're hanging on to them because they're cash flowing and they have nowhere else to go but up. So why put them on the market?
What about the REOs that are potentially going to come on the market? Because there's this, shadow inventory. 58% of all houses in Las Vegas are underwater. We know that there'll be more REOs at some point, or they'll get sold to hedge funds and they'll eventually hit the market. You think that that's going to cause the market to crash, or you think they'll just come on the market at market value and...
They're actually coming on the market above market value.
Okay.
So what's going on is the institutional sellers, they're looking at the market, they're looking at the market trends, they're forecasting this. Look, we're talking about billions and billions of dollars worth of real estate, so they're spending a lot of time tracking the market trends. Mm-hmm. So what they're doing is they're looking at the market, and when I do my broker price opinion, I'm looking at the market and I'm allowing about 1% per month for appreciation. But they're looking at the market and they're saying, okay, 1% per month for appreciation plus a premium for market scarcity. Now that premium varies as a percentage, but it is significant, and we're talking. In a lot of cases, that premium is more than 10%.
Okay. What about the people that are out there doing videos like this that are saying that market scarcity is false, that there's all these houses that are going to flood the market and prices are going to collapse, so if you have a house, you should sell it now?
Well, the people who say that the market scarcity is false must have a wonderful crystal ball, and they must have access to properties that the rest of us don't have access to. Because what's on the market is what's on the market.
Okay.
As far as the shadow inventory is concerned, that's irrelevant. It's irrelevant for a lot of reasons. Number one, we've had this shadow inventory for more years than I can count at this point,
right,
and it has not shown up. The second reason why that's irrelevant is because the institutional sellers have that inventory, but they have no reason to dump it on the market. They have experience with that, and they're not going to do it again. They are metering out the inventory, and it is coming on the market at absorption rate or even lower than that, which is the reason why our inventory is so low, and it has been low for a long time. We've seen appreciation it started out about 0.5% a month a year ago at this time, and it's actually pushed up to about 1% a month in the last probably 4 or 5 months, and we're seeing that. It's difficult to really trend that unless you're looking at it very carefully, and you're really looking at when did these houses go under contract, what happened to them, and you're seeing it in the short sales too. What's interesting about short sales is that they'll come on the market for price X, they'll get an accepted offer. By the time the bank approves it, the bank will approve it for a much higher price than what the agreed upon purchase price was, because the bank has realized that we are in an appreciating market and they're not going to honor a price that was valid 6, 8, 9 months ago when that property first went under contract.
Okay. So let's talk about a $100,000 property that you can get $1,000 a month rent for.
Okay.
So you're getting, in gross terms, 1% per month return on your money in rent, and then potentially 1% per month in appreciation.
Right.
So that's, in theory, you could be getting 24% appreciation per year gross, not counting any property management fees, taxes, insurance, things like that you would have on a house, potentially. Do you think that number... Because when I talk to investors, all they want to know, we ignore potential appreciation. They just want to know cap rate. which is the percentage of their cash that they get every year back.
Okay, so I'm going to answer that kind of being a little cheeky.
Okay.
Investors ask me, is it a good time to invest? And my answer is, are you a good investor? Okay, an investor needs to keep in mind everything about the property, not just the cap rate, but also the appreciation or depreciation on a property.
Okay.
Okay, so excluding any part of that really doesn't make sense. When an investor says, I'm going to exclude the appreciation, then would you exclude the depreciation if it was a downtrending market? That doesn't make sense.
No, they all say they want to buy at 30% in a market because they heard the market's going to crash.
Well, they may have heard that, and perhaps they are wiser than people like Warren Buffett, who are doing everything they can to purchase property in our market.
Yeah. Awesome. Okay, so that's Juana's take on investing in the Las Vegas real estate market. This is something we will track throughout 2013 and moving forward. Anyway, that's my update for today, and hope to see you on another video. Thanks.